All right, welcome back, everybody. We're joined by Tom McEntee, equity and options trader. Tom has been trading equities for over 30 years. Tom and Larry used to trade together in the pits way back when, and he calculates options premium and deltas and all sorts of Greeks to really come up with some good valuations and good risk-reward opportunities very quickly, all off the top of his head for the most part. Larry always talks about that, how he's the human calculator. So Tom, how's it going? Welcome.
Very good, thanks. Good to be back with you guys again. It's a balmy 95 with matching humidity up here in New York.
Yeah, well, it's end of summer, and that's part of it. We've actually had a pretty active last few days, but everybody's expecting this week to be a bit on the inactive side. But there have been some great opportunities. And so taking us through last week, you actually took us through a lot of your individual trades that you've had over the last week or two and actually showed us on the chart, what you were looking at in terms of the setup. And so we're hoping to go through that again and, take us through what you're looking at the moment and then the way you've expressed that, finding good risk reward opportunities.
Sure. I've done a few. I'll keep it simple because I'm assuming we're going to do this a little bit more often going forward. So let's go with a couple of trades that I put on in the last 2 weeks that are still on, and we'll start with the letter X, U.S. Steel.
Yeah, and I'm updating that. I'm putting it in the chart on the right hand side for everybody to see.
I've been trading the thing for I guess close to a year on a daily basis. So obviously, the stock probably got stretched out at 47 and change. Back when was that? Was that April? March? I'm just trying to think. I'm sorry, end of February 28th. Okay, blah blah blah. I've been trading it kind of on the long side when it was a throwaway down in the teens and stuff like that. I kind of got shorted up around 35, 36. If you go back and look on the chart, I think it was the Friday after the bottom, 216. You look at 216, I'm looking at my chart here. 216 is the first mention of tariffs that Friday, and the stock ran during the day, no news. After the close comes 5 o'clock, news about tariffs. And it's a funny thing because if I wasn't for bad luck, I'd have no luck at all. I was short some. I think I was short I'm just trying to think where the stock closed, like 44. Yeah, okay. Stock closed 44.75 that day. I was short the 45s that expired that day. And I had done some scrambling because the stock went through 45, blah, 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 scrambled back. Obviously, I was short and I was a loser. And then, so the 45s went out, so that helped. Then the news comes out at 5 o'clock. I said, you know what? Only in my world does news come out at 5 o'clock. I said, what's the probability that I get assigned on these 45s? So I said, with my luck, probably... You'd like to think it's a random walk, but with my luck, probably I'm running about an 85 delta, but I'm going to be short the stock at 45 because the stock was trading after hours 46 spots, 60 somewhere in there, blah, blah, blah. And then, of course, then the rest is history. So what I'm looking at here is I think the stock, now it's obviously unloved, hated. I think there's a lot of burned money. But I think more importantly, and the way I like to evaluate to evaluate things or value things is I try to leverage technicals with vol metrics. Okay, so I know that the stock, the high was 47.5. We'll call it 47.60. Is it a 1 year? The 1 year low somewhere around right in here at 24. I think about $24 somewhere around there.
Looks like we're traded close to 28 is what I'm seeing.
I see a 1 year low on 926 at about 24 spot 10. Okay, blah blah blah. 71. So I'm thinking 35.5. So I'm saying 24 is the low, 47 spot 60 is the high. All right. I want to get a midpoint. So that's 71.60. That's 35 spot 65 on a midpoint. Which, interestingly enough, you can't make this stuff up. If you go back to 216, the just trying to think. The low that day was 38.15. I'm just trying to think, when did tariffs? 215. If I look at the low that day on the tariff thing, I think we got down to like that 35 level. Just trying to hold on 1 second. A little bit off here. 215. here. This is where I'm on. Okay, you go back to that 230. I keep zeroing in on 35. This 35.80 level. I don't know what the hell I was looking at. Okay, blah blah blah. So I'm going to focus on that number. I'm going to focus on 30. What did I say? It was 35 spot 65, right? 24 the low, 47.60 the high, 71.70. Divide that by 2, I get 30. I'm sorry, I get 35.85. Okay, I'm looking at that number. And that to me was a big number from back in February. I can iron that out. But let's just move forward. I'm looking at 35.85. I think it's got a good shot to come back in there. And I think interestingly enough, maybe this is what I was looking at. The high post earnings on, I think the earnings came out 8.1 the earnings came out 8.1. The high that day was 36.60. The low was 35.5. That the earnings day. So I'm targeting that earnings day low. Then of course, since then we got down I think 20. We trade through 20. Yeah, we got to 28.40, and now we're back up here around 30.7. But now even more so than that, and I put the spread on 2 weeks ago, and I think I'm a small winner to a net scratch. Nothing material one way or the other. Volatility over the last, if you get a chart of U.S. Steel, the breakdown, the average 30-day implied vol in this thing for the last 52 weeks, and we'll keep it short, is the median's been about 45. Okay, currently right now, I mean, we're on the lows right now. If I go back, if I look at SEP 28, we'll go out a month from now. SEP 28 is a weekly. I think probably more a better benchmark might be the SEP 21, but whatever. We'll say we'll look at a 30-day option. The September 28th series, that option series, is trading like a 33 vol. That's as low as it's been for the last 52 weeks. So I'm looking at that and I'm saying, well, I see a stock that's depressed. Look, it can go low. I'm fully aware of that. You can go back to 24. I think the stock's could trade as back at that 35.80, 36 level, up and down. I think a stock that's depressed. Do I want to buy it and sell options against it? Well, what am I getting for the options? That's a big thing you got to ask yourself. Am I getting paid? And Larry knows what I'm talking about. Am I getting paid? Because essentially, if I buy this stock at, I think it's 30.70, we'll call it. If I buy this stock at 30.70, and I go out and sell, well, I want to sell a 5% out of the money call in U.S. Steel. Let me just hit this up for a sec. I go out a month. 5% of the money is like about $1.50, $1.80. So that's like a 32. We'll say a 32 and a half. I'm getting 44 cents for it. So it's like 45 cents. I'm selling. What you got to realize is when you're buying stock and selling calls, what you're doing in essence, or synthetically, but it's the same thing. You're selling a put. Period. That's what you have on. Okay? You're selling a put. It's the same thing as selling the 32 and a half put. If I did that at 45 cents against 30.70 stock, it's like selling a put at 30 at like $2.20.
Which expiration are we talking about here also?
I'm looking at SEP. I'm going to go to the regular way, SEP 21. That's 24 days to go.
Okay.
SEP 21. I'm not getting paid. I mean, you're not getting paid to sell vol in this thing. I mean, you're at the nadir. Could it go lower? Yeah, it could do anything it wants to do. But I want it. I mean, this thing 3 months ago when the stock was pressing, when the stock was trading in the mid 40s, vol was 64 and it was jump ball. Whatever you wanted to do, you put an offer out there, you got filled. The way I approached it then was very, very different than when I approach it now. When the stock pulled back and I wanted to finance maybe some type of long bet on the thing, I would buy what I would. You could do 1x2s for credits because the options were the most expensive thing on the board. Well, I guess the stock was pretty expensive as well, but the options were the most expensive thing on the board. And I at that point, I wanted to be a net seller of options. If I think they're the most expensive thing on the board, I want to be a net seller of them. Look, and I'm not going to be, just completely naked and stuff like that. I got to know what my exits are, but I'll put on things that are measured. Now, I think the exact opposite scenario exists right now, where I think the stock is somewhat depressed. I know it's been bouncing around in here for a while, but I think the volatility, the exposure to optionality is as cheap, and this is a fact. I mean, it's not fake news. This is as cheap as it's been for the last 52 weeks. Like I said, caveat is that it could go lower, no question. But I can't pick bottoms. I can't pick tops. I think I want to buy it here. Look, I bought it at probably 36 vol 2 or 3 weeks ago, but I'm still a net winner on the thing. What I'm thinking is I sold the Jan 32 calls. You can look at it on your screen. I sold the Jan 32 call. I did what's called a call tree. Now that Most of the guys from Chicago know this. My only knowledge of Chicago is probably the 85 Bears. But I sell the 32s, Jan 32. I want to go way out. I think this vol is so cheap. I mean, this is another thing I want to emphasize. When I think something is as cheap or as cheap as it is going to get, and like it could go to a click lower, 2 clicks lower, no problem. I understand. I want to own that for as long as possible. Why don't I? If I want to borrow money at 2%, I'd want to go out as far as I can, because I think you're at historically low rates. Same thing applies here. You got vols that are on the freaking bottom. There's disgust in the stock. There's disgust in the volatility. It probably burned a lot of people. That's the way, that's what the markets typically do. They burn you out, and everyone's either afraid to buy it or very comfortable selling. That's okay. But I think so. I want to go out to January. And another thing, and I think we spoke about this before we started the chat, is that I want January, by going out, 5 months? By going out 5 months, it gives me time to be wrong.
Right. It gives you time to also, I guess, maneuver around if, something else pops up, and you can maybe sell something else or buy a different spread against it.
Absolutely right.
So it looks like you're short the Jan 32s, you're long the Jan 34s, and you're long the Jan 36 calls?
That's correct. I think I paid 50 cents for it. You can go check the chat. It's about 2 or 3 weeks ago. All right. Now, with something like this, if I buy these Jan 32s and I pay 50 cents, I don't know where it is right now. I think, like I said, I think I'm a small winner, small loser, something like that. All I'm looking for is I look at scenarios like, hey, I am willing to admit that I'll probably be wrong, but I mean, how much time do I need? What does it take? What do I need in the stock? Out, like I went out 5 months in this thing. Hey, how do I look out a month? Where do I need this thing to be out in a month before this thing turns positive? So I'll say, hey, I'll look at, on this particular thing, I'll look at 920. I'll look at a month from today, 928. I initially looked at 828. And I told you, and I think I put it in the chat, I needed $31 for the thing to be profitable. I mean, obviously we got that. But I haven't sold any stock. I wanted to sell stock up around the high 31s. I never got to my number. Didn't sell it. Still just long the spread. So I'm a scratch to a small one. Okay. Now I'm looking out here. I still like the trade because I know according to my calculations, with the vol here, these depressed levels. Now you got to remember, in January I'm buying a little bit higher vol. I'm buying like 38, but that's okay. It's usually about 42, 43. What I know is if this stock trades above 32.70, $2 higher up, by any time between now and Sep 28, I'm a winner. Okay. Now, the quicker it happens, the better.
Right.
Obviously, right? Quicker it happens. Hey, if it happens tomorrow, I'm a real big winner. But I don't. It's not going to happen tomorrow.
Right. Because in that example, just to confirm, you're basically your 34 and your 36 calls, which are further out of the money. They'll actually go up by more based on the volatility increasing and their delta increasing, right?
Exactly right. The delta increases, the volatility increases. And of course, I have more time. I've got another 30 days. What would happen tomorrow? I've got another 30 days with this thing. Like here, if I went out to September, the 10 days from now, September 27th, September 7th, my break even from here is about 31 and a half. So 70 cents, roughly, from here. So obviously, the break evens are closer to the current price, the nearer duration in time we're going out. So I'm just looking for a movie. Look, I have on this thing I pay 50 cents. I know if this stock trades, if this stock were to trade at 30, we'll say, hey, look, miracles happen. Stock trades 33 by September 7th. Not going to happen, but let's say you're getting 3x. I'm betting 50 cents it's worth $2.
Right.
That's the kind of thing I'm looking for. It's 50. I think I'll be able. My nightmare scenario was the stock going out at 34 at January expiration. Because what happens there? The 32. You want to walk through it. The 32 calls are worth $2. The 34s and 36s expire worthless. Okay, that's my nightmare scenario. Now, obviously, a lot of things are going to happen between now and January. I would imagine. I don't think we're just going to hang out here and lay around this particular thing. But if I were to get, if I get a sharp up movement.
Tommy there? lost Tom for a second. Sorry about that, everybody. Last thing I heard him say is if we get a sharp up movement.
Look, no one liked.
We're back. We lost you for a few seconds. The last thing I heard you say, we lost you probably for a good 30 seconds. You said, if I were to get a sharp up movement.
Yeah, if I get a sharp up move, look, I mean, I look at scenarios like, hey, on September 14th, I'm a double in this stock on September 14th, anywhere between now and September 14th, the stock at 32 and a quarter. I don't need much to double my money in this thing. That's what I'm looking for.
Right.
I'm giving myself room to be wrong or time to be wrong, and I got real good upside on a stock that I think is kind of depressed. It is depressed.
Right.
Like I said, it could go lower, but I don't care. It's going to take a long time to get that 50 cents for me.
Okay,
that's what I'm looking for.
Yeah, look, it's a great risk reward, and like you said, you're risking 50 cents for a lot of upside. So we'll definitely keep an eye on that and keep us updated on X.
Okay.
Next, let's take a look at Macy's. You are long the Novi 40 calls, and what do you have here? The Novi
short arc 39s, I believe, right?
Correct. Yes. Right. So you're long the Novi 40 calls, short the October 39 calls at a debit of 10 cents.
I'm sorry. I'm just go ahead. I'm sorry, Mike.
No, that's fine. And I got the chart up here for everybody to see. I have the daily chart. We're right now trading at actually I don't have the price, but somewhere
like
in between
36.40
and a half. Yeah.
Okay. I mean the methodology behind that. I think I went through this last week. I think this came out of a similar trade that I was wrong on, but didn't cost me anything. I think the stock was trading, whenever earnings were about 2 weeks ago, stock was trading roughly 41 and a half. I did some work. I do a lot of work on earnings, a lot of work where I'll look at what the straddles tell me what the market is looking for. But I think it's more important, in my opinion. I like to look at what is the max move. Like if I'm focusing on a weekly option, I haven't really looked at anything in earnings today. But say a stock was coming out with earnings tonight. XYZ stock is coming out with earnings tonight. And they have weekly options, which most will do. Okay. If I'm looking to sell those weeklies and or buy those weeklies, I want to look at how this, I know I have, comes out Tuesday night, I have Wednesday, Thursday, Friday to trade. Right? Well, I have Wednesday, Thursday, Friday to be long those options, or conversely, be short those options. So what I want to see is what is the max move, up or down, that the stock has realized, say in the last 8-10 quarters, post earnings. What was the percentage move away from the earnings close when it closed on where it closed the day of earnings, and I'll calculate that. So in Macy's, I went back 8 or 9. I think I went back 8 quarters, and the average move was somewhere around 11%, or I'm sorry, 13%, with 7 of 8 moves being greater than 11. So I thought there was a high probability it could be greater than 11. I think the market was looking for somewhere around 8%. So I said, well, I think I get 11% out of this. The market's telling me that. And I'm almost positive. I kind of I want to depress outliers and stuff. I think there was a 32%er in there, and I want to collapse that. So I'll look at one standard deviation move away from whatever that mean was. So I said, okay, I'll look for 11% move. So Macy's 41 and a half, 11% is roughly $4.50. So I concentrated on the 46. You figure 11% of 41 and a half. You see where I got that, right? 41 and a half, 10% is like 415.
Right.
And another 41 cents, 456. So I'll say 4.5. 4.5 to 41 and a half is 46, right? 4.5 plus 41 and a half. So that's where I'm focused. I focused on the upside for whatever reason. I don't know why. I just did. So I like to pick a path. I don't like to try to pick both ways. I want to pick a path that I think I have a better chance of success on. Obviously, I was dead wrong. So I paid 2 cents for. I think I sold that week's 46s, bought the next week's 46 and a halves. I'm sorry. Sold that week's 46s, sold the next week's 46 and a halves, and bought, I think, as it turns out, it might have been last week's 47s. I sold one, bought 2. And I think all in, I think I paid 2 cents. Obviously, we saw what happened to the stock. The stock traded through 35, I believe. Did it trade down to 34s or something like that? I'm almost positive. 34 and a half or 34.80. Anyway, I'm a loser there. But anyway, on earnings, I said, you know what? I looked at it and I said, what happens out a week from now? I look, it's usually had some sharp moves. So I said, let's play that. I'm looking at the chart here. Let me get my chart up for 1 sec. I'm just trying to think, what was I focusing? I was focusing on this. I was focusing on that earnings high. If you look at it, I think the earnings day was earnings high was right here, right? Okay. The earnings came in on 8:15 on the 8th, so 8:16. I looked at that. I wanted to focus on that high, and that high was 35.94. Or I'm sorry, and the day before earnings, the high was 30. That's what I said. The day before earnings, the earnings came out $39.30. That's what I'm focusing. I'm looking at that. So I'm looking at the stock trades back to 39, which it did, I think, a couple of days ago. So I said, how do I fashion a trade that's going to make, that'll really, I'll get a couple of X to 1 on a move back to where I think 39, 40, somewhere in there. Because I think maybe the stock was kind of washed out, maybe a little bit open down. Obviously, it's come back down to 36. So what I did was I bought the November 40 calls and I sold the October 39 calls, which at the time, 2 weeks ago, was delta neutral. And what's very, very important is I like to take in volatility clicks. If I buy a spread like this, I want to take in volatility clicks. So what I mean by that is I'm essentially buying and/or selling skew, right? So if I'm buying, skew is the difference between, it's just simply, there's horizontal skew and vertical skew. Vertical skew, because I think we've gone over this before, but it bears repeating, is that institutions are natural put buyers and natural call sellers, right? Put buyers for protection, call sellers for income. So that skew, if you made a chart of an option skew, it's going to be sloping from the upper left to the lower right. So the further out of the money downside or tail risk puts carry a higher volatility, whereas the upside calls are always depressed because they're under pressure. Because institutions or people who are long underlying stocks, long the S&P 500, are willing to sell calls into it, right? They'll have an overlay where they're buy right. So they'll sell calls into it. So that's why you get that type of skew. So now there's also horizontal skew, and that would be the skew that would be in existence from month to month or from expiration to expiration. Now that's usually around earnings, or usually around events, earnings, maybe like in a biotech, an FDA announcement, or maybe proximity to earnings, or in some of the retailer stuff that you got same store sales. And I think more recently, and I think more that would resonate more with our audience is Tesla. Tesla in the news, certainly the last 2 or 3 weeks. The stock gyrating $100 range, 288 to 387, something like that. Musk in the news. So horizontal skew got blown out in terms of like the near-term stuff was trading 10 to 15 clicks over longer dated options. So the same thing happened here in Macy's. I digress. So you were able to buy November options, sell October options for a volatility credit. Like right now, I'm looking, the no 40s are about a 38 volatility. Call it the OC 39s are down with 31. I did that for credit. So that spread there, I think I paid a dime for it. It's trading 72, about 47 cents. Wow. Look at that. So that worked out pretty well. I have it off. That worked out pretty well just because I'm getting that. What I want to do is get some type of decay. I'm going to get, the closer we get to October expiration, I'm going to get geometric decay. No, actually,
right.
Yeah,
and so ideally with that is that in the month of October we trade higher, but not necessarily through the 39 strike. But then it leaves you basically long a naked call for 40 with an extra month to go.
Right. So that spread's appreciated now. That's another thing I looked at. Okay, now I gave you another one that I did. I want to walk you through TWLO. Here's one I'm wrong on.
Okay.
TWLO. You want to put the chart up?
Yeah.
TWLO. I'll give you one that I'm wrong on, how and why I'm wrong, and what I'm trying to do to remedy. Well, I'm a little bit less wrong now than.
Well, that's been a straight runaway train to the upside. And actually, as a side note on that, our company's going to start using Twilio to communicate with everybody on trades, and so I can see the value in this company. I mean, it's really the business side has really blown up, and the stock. I mean, we're trading in the low 20s in this year, which is just remarkable.
I got involved. I think I got involved in a thing it was 25. Was it late February?
Yes.
I think the stock was $25, and the earnings came out, and the stock traded, if I'm not mistaken, traded through 30.
It's been a beautiful chart. I have it up right here. I mean, really, in March, it was trading $22, and then good earnings call, and went straight up to 40, consolidated for about a month or so, up to 55, consolidated for 2 months, and then 55 to 75, and then another about a 2-week consolidation, and now we're at 81 here.
I mean, it's amazing, an incredible move. Look, and I've been trading this. It's giving you some there's been some volatility setups that allowed you to play the short side for looks and stuff like that. So I was able to defray things, and you had some skew. But net, I'm a loser on the thing. I'll tell you that. Now, I think, if I'm not mistaken, I was short this thing. We'll say at an average price in terms of the chat here. I was shorted at like the 77.5 level. Stock came in, I think it was about a week or two ago, to 76.5. And I wound up buying a set. I went out, and this is what I look for. I want to buy, we talked about skew, okay? So I want to go back. I want to, where can I protect myself in this thing? The cheapest possible. What's the cheapest possible way to protect myself in case I'm wrong? Because occasionally I am wrong. Nobody else. That's why I'm not on television. So I think I know what I bought. I bought the SEP. Initially, I bought the SEP against that spread. When the stock came back into 76.5, I bought the SEP 75.80 call spread. You see that right now? And I bought that then with the stock at 77 because there's no skew. If anybody has an option page out there, they can hit it up. Now, as I become more fluent with the snipping tool, I'll be able to paste it in the chat.
Look at that. But you joined the Opportunistic Trader, and your technology is...
Snipping had an entirely different connotation.
You're a new man.
Before I spoke to you, I'm looking for a tool. But, yeah. So what I'm looking for, if anyone can put up, has an options montage, and you can hit up implied volatilities of different options. Well, there's very little skill. Like we'll look at TWLO right now. The stock's about $80. Was it $80.10 or something like that?
Yes.
Yeah, $80 even. Okay. Now I'm looking, and now I'm sure. So I bought that 75.80 at whatever the heck I did, and the stock ran up. I sold stock at high 77s and a high 79s. So I'm wrong for about $1. We'll see. We sold it at 78. I'm short it at 79. We'll say more stock. So now the stock's $1 against me, a little bit further. What I'm looking to do now is, if the stock comes in a little further, I'm going to try and buy the September 80.85 call spread. Okay? Yeah. Now that spread's setting up at around, what is it, about $1.85? What is it, $1.85 bid? I think I can't. About $1.85 bid. I'll look to pay about $1.75 for that spread. I want to get on top of the stock that way. I'm going to give myself. I'll buy that call spread to overlay it on top of short stock. Okay, and I'm willing because I'm not paying. If you have access to the options montage, you'll see the vol I'm paying the SEP 80s. I'm looking at like a 40.6, and the SEP 85s is about a 40. I mean, I'm paying. To me, that's 0.6 skew. It's just flat because what you have now is in a stock like TWLO, and then there's some tech stocks like this. Apple comes to mind. Is that there's flat skew because the stock, as you noted, has had an incredible upside move, right? We've gone from 24 to 82, right? 50, 58. That's a big freaking move. That's about what, 235%.
Tom, I think we lost you again. Sorry, everybody. Give me 1 sec. Oh, we're back. Or
represent lottery tickets to people, so they maintain value, and that's why they never decrease against at the money calls. That's fine. It takes two to tango. That's what makes a market. I want to be there should be some type of skew attached to buying an at the money call and selling a call that's roughly about a 30 delta. In other words, like the at the money call will be about a 50 delta, right? You follow this?
Right.
And the September 85 call will be about a 30 delta, a little bit less, 29 delta. I should be paying a vol debit for that, some type of a vol debit. 1 click, click and a half, 2 clicks, something like that. But I'm paying 0.5. I want to do that as many times as possible and sell the stock. I'll be against it because I'm paying them a depressed rate for that skew. Now, what I want to do is, in a perfect world, now if you look up and down the vol chain in TWLO in September, I'm just focusing on the September 21 options for right now. The skew is pretty flat all the way down, even in the like the SEPs. I'm looking at the SEP 75 puts 41.5 vol. To me, that tells me with flat skew like this, and and with flat skew like this, and well, I have you here. I will check something out. I think this is very interesting. Here, 30-day vol. 30-day vol in TWLO, say on the 21. Say the one I'm looking at is about a 40. Okay, 40%. The 52-week median's been about 43.5. Okay, so now the average. I want to look at. Here's that dirty word again. I want to look at skew, and I want to look at the disparity, or the difference between that 25 delta put and the 25 delta call. Okay, and now it's been trading. It kind of bounces around by about 1.9 right now. So I'm thinking there's no skew here, very little skew. So here's what I want to do. I want to buy that SEP 80.85 call spread. I'll bid $1.75 for it. I'm sure it's stock at say 79. Okay. Now, if I'm lucky enough, if I get a hard down move, I am looking on the chart. You have the chart up there? Yes. I'm bouncing all over the place.
Yeah.
I'm looking at the chart, and I see this stock. Look, and I'm dead wrong, man. I got short this thing way too freaking soon. So take it for what it's worth. There's a yawning gap here between 72 and 63 on earnings. Okay, you see that from 8.6? Do you see that? I mean, you got a $9 hole in the stock. The stock's full of holes. It's really never been challenged. Maybe that one time back at end of July. But off the earnings, it completely reversed. The V bottom there into earnings. Got up to, I think the high was 63.60. And the low since earnings has been 72.24. I want to look at that line. I want to look at top. I know there's a gap between 72 and 63. In a perfect world, and this is what I want to do, doesn't mean I'm going to be able to do it. If I get any type of hard down move, I'm going to try to look to sell that top of gap and hope I'm wrong. Try to sell that. If I get a hard down move to like 75, 74, and I get some type of a heightened anxiety level in the puts where people start to reach for them, and reach is a relative term here in this stock, obviously. I'm going to look to sell those 72 puts. That's what I'm going to look to do, and ideally, I'd love to sell them for $1.75. Now I'm going to need some type of hard down move in the stock between now and September expiration in order to realize that. But that's the game plan. Or I'll sell something else. But I've just been focusing on this. I'm just trying to buy cheap vertical skew. And look, I'm buying 40 volatility and selling 40 volatility. So I'm keeping the Vega low. I'm going to pay a higher price if I'm buying 60 vol and selling 60 vol, right? Because I'm buying 60 vol and a 50 delta option and selling 60 vol and a 30 delta option. So the lower the absolute volatility, the lower the spread. So that's what I'm looking to do. I can win two ways here. Win on the stock going down. If I can buy that spread at the price I want to buy it, I'll have ammo to sell downside. Like all through February, March, I guess mostly through April, and the spiders, you had one opportunity a week to do stuff like this, where you could. I'm not saying you haven't had the opportunity at 12. I'm just hoping for it. But in the spiders, you had opportunities on those declines if you set yourself up right to be a buyer of call spreads and a seller of downside puts because they got bid up. I mean, obviously, no one's bidding up puts and spiders right now, but that's the game plan here in TWLO. Okay. So now, what else did I give you? I gave you X, I gave you M, I gave you TWLO. I digressed on. I gave you 4 trades.
And then actually the spiders. But actually, you know what? Let's just talk about a few questions actually about skew, and then we got to jump actually. But so when you look at skew, right? What do you look for to find attractive risk-reward opportunities when you're looking at skew?
All right. Well, that actually feeds right into that spider trade that I never got it. I was bidding for it. You can put the spider trade up.
Okay.
Well, I think everyone knows what the spiders look like. But
runaway train to the upside.
Yeah. We have nothing to fear but fear itself. Look. You're at depressed levels. I mean, I'm looking at. Hold on one second. Let me just get my thing up here. All right, here. Last 52 weeks, obviously, I'm going to go out on a limb even, this is the last 52 weeks on average. The average at the money vol has been, on a 30-day basis, been 10.3. That's been as cheap as it's been. That's as cheap as it's been, period. Even with the dislocative move of, February, March like that. It's been 10.3, okay? Now, what I would look at here is I want to look at that scale. Let's just keep it simple and hop on the same thing before we go into more advanced stuff. But like the 25 delta put, that's a for a lot of these upstairs houses, that's how they base variance swaps and stuff like that. But here, 25 delta put, 25 delta call. The average difference in there for the last 52 weeks, it's been 3.4. In other words, the 25 delta put's been trading 13.4. 25 delta call's been trading 10. Okay, The difference is 13.4 minus 10, 3.4. Right now, it's trading like 2.2. It's been over 3.4, I think, twice in the last 20 days. And now
so what does that tell you? Does that tell you that the market, there's less fear of the market going down?
Well, here, the skew has typically been 3.4 on an at the money vol regime of 10.3. So roughly, what's that, about 32 and change percent, 32.5%? Okay. Now you're running 2.2 on 8.4. It's not even 30%. It's about 25, 26. I'm saying there's much less fear in the marketplace. There's no question there's less fear. So what I want to do in here is I'm not willing to call a top in this thing. I don't know. I think we're close. I mean, hey, I look at 30-day and 60-day stuff. I think I put it in the chat where if I'm not mistaken, we're 90 days from low to the day and 60 days from low. So that's what I'm looking at. I think there's a good chance a top comes in here on the next day or two. But more importantly, let's divorce all that. I'm not willing to call a top. I don't know. But I'm looking at that, so I'm cognizant of that. But I think the volatility metrics tell me that there's no skew to the downside. People really aren't afraid. They're not afraid. I mean, period. That's it. Because you would see some type of this variance thing wouldn't be trading at 2.2 and it's historically 3.4. There's no fear, and I guess for all the right reasons. But I'm saying you're a depressed vol and you're in a depressed differential between this put and call. So what I want to say is I want to express a directional viewpoint.
Yeah,
I've been trading this for a long time, as long as Larry, maybe even a little bit longer. I don't think we're going to stay here at the 2,900, give or take.
That's about it. 28.99.
Either we blast up to 3,000, or we got some type of hard corrective move coming. Because it's like I think Mark Fisher said, he's 100% right. I believe. It's kind of what I've always believed. Nothing matters till it matters. So I say, hey, let's go out. I'm not willing to call a top. What's the cheapest way I can fashion a downside bet? I want to have optionality. I'm not paying a lot for tail risk. I mean, what's the most recent low in this thing is? I think I put it in the chat. Where is the most recent low? 2690. That 90 days ago. Hold on, bear with me for 1 second. Hold on 1 second. Yeah, I'm looking at 26.9. Was it 26.92? That's 2 months ago. 628.18. I'm going to fashion something around that. So what I came up with, and I'm just bouncing. I looked. Let's go out as far. I want to go out to November. I want to take in. Look, I'm taking this. Don't tell anybody, but I think there's some pretty big elections coming out. There's a big election coming up in November.
Yeah.
So I want to get some type of optionality going into that, right? And I don't think anyone's really paying attention. No one's. They're not paying attention because I'm not paying that much. I'm buying cheap volatility. What I want to do is I want to buy a put trade. I don't think we're going to stay. I think we either go to 3,000 and run away, which is okay. But I think if we do get a hard move, we're not. I mean, everyone's waiting for a shallow correction. So you know what that usually means. You're probably not going to get it. So there's always that one you don't want to buy. So what I was bidding, I didn't get it. I'm bidding $1.31 for it. I want to sell. I'm selling essentially about a 1%, 1.5% out of the money pool. I want to sell the 285 puts in November. Okay, they're regular way November puts. November 16, I think is the inclusion. Okay, I'm looking to sell those. I'm looking at, and I want, they're about $4 and $4.40. I'm looking to buy the 280s and the 275. That's a trade, okay? So I'm buying I'm buying the 275 puts. I'm buying the 280 puts. I'm selling the 285 puts, all for $1.31, because I'm not paying any skews. Like I said, the vol curve is usually sloped from the top right to from the top left to the lower right. But you're not paying the skew, the differential in skew between the options I want to buy, the 275s and the 280s. I'm not paying much of a differential because if you look at the TWLO trade, I said what I should be paying more skew to buy the at the money 80 call and sell the 30 delta 85 call. Well, the converse is true here. The same thing is true here. I want to buy an out of the money put that's a little bit further out. I'm going to want to buy the 275s and sell the 280s, and buy the 280s and sell the 285s. So what am I paying in skew, right? Because that skew should go. The lower you go, the skew should be more pronounced. But what I'm looking at is like I'm paying maybe one click between the 75s and 80s, and about 1.3 between the 80s and 85s. I'm paying very little. So these are the kind of things I want to do. I'm going to get that kind of optionality. Once again, I want to look at how I want to give myself time to be wrong. I'm fully aware that I am probably going to be wrong initially. And what gives me that? What gives me time to be wrong? And I know if I get a move down to two, all I need is 282 in the next month, and I'm a winner on the spread. 282, I know it seems like a long way away. It's $7, but we are looking at a $290 stock.
Right.
So I think I give myself a month to be wrong. Obviously, the sooner it happens, the better. I got to gain.
Yeah, that's what you do. You look for a lot of great opportunities that have good risk-reward opportunities in them. And, if they don't pay off, you're not risking a whole lot. And, you put a lot of different calls out there. As you said, you want to get paid on a lot of these. And, just looking for good risk-reward opportunities. That's the discipline. That's all it's about. You look for good, you put on enough of them. I'm looking to get obviously multiples of X. And a lot of these things will morph into a position. As TWLO did from a long time ago. But, it constantly evolves. These strategies are fluid. But just be cognizant, anybody out there, just be cognizant of what volatility you're paying and the biggest thing in this thing is like, give yourself room to be wrong, because everybody's wrong at some point, right? Absolutely.
When you're right, that's great. But if you're wrong, can I still make money? What if I'm wrong for the first 2 points of this thing? How badly will that hurt me? Well, it's not going to hurt you that big because you went out a little bit further. Take away one thing from this, give yourself room to be wrong. Look at the differential between the options you want to buy and the options you want to sell. What are you paying for that? Then you can say, why am I paying that? And how does that look on an historical basis? Is this historically high? Is this historically low? Is it time to buy options? Is it time to sell options?
Well, I like that comment you just made. It really, give yourself room to be wrong, because like you said, getting into trades, whether it be optionality, whether it be futures, equities, you got to give yourself some room. If you don't, then your timing must be impeccable, and it's very difficult to always have impeccable timing. So you got to give yourself proper room, set your stop levels, or if you're using options, that sort of thing, protection.
Right.
So.
You don't want to be threading needles. There's no question, right? That's too difficult.
Absolutely.
That's way too freaking difficult to thread needles. I think if you give yourself room to be wrong and you do enough things at the right price, all right? That's an important concept. You do enough things at the right price, with the right technical setups, in the long run, you'll be way ahead of the game.
Absolutely.
In the long run, you'll be way ahead of the game. Because, this game is, the candy store opens every morning at 9:30. You just want to take advantage of the opportunities and let them come to you. And just do your homework. Look at what you're paying. Look at where you are historically. Earnings season will be rolling around in about 5 or 6 weeks, right? There'll be plenty of opportunities there, and I'll be able to put some more stuff in the chat. There's a lot of ways to play this thing, and I'm just trying to be. At times, I'm even agnostic about movement. I don't really care. I just want to have. I'll just trade the options I'll just trade the volatility as an asset class.
All right, so you've given us a lot of good info on the equity side. What about on your second biggest market that you trade, the football market? What are you looking for as the exciting football season gets going in a few weeks?
All right, I'll tell you this. I've been hot the last couple of years on some of these over-unders. I like the Washington Redskins over 7 plus 20 cents.
And
I think you get Alex Smith in there to replace Cousins. The only thing Alex Smith does is seem to win 10 games every year. They get Jonathan Allen, who I thought was a beast last year, the defensive tackle from Alabama. He missed about 10 or 11 games. Hopefully he's back now. And they also got this kid, Deron Payne from Alabama, who I'm really high on. I think the middle of that.
What about Adrian Peterson? Is he expected to play a role there?
Only if it's 2012. Only if we go back in time, Mike.
Tomorrow at tomorrow noon Eastern time, we have Chris Heller, who puts out a podcast called Friday Fantasy 5, and he's been very successful in fantasy football. He's going to be joining us tomorrow to talk some fantasy football stuff like that, so you can tune in and check that out. What else do you have? So you like the Redskins outperforming the NFC East, getting 7 wins. Anything else?
I like the Redskins there. I would love to get a market. I can't do it. I've tried. I want to get a market on New England not winning the division. Because I don't know, is Brady 39 this year or 41?
No, he's going to turn 41. I think late in the season, around Super Bowl time, he's going to turn 41. And yeah, I mean, as a Dolphin fan down here, it's not going to be the Dolphins. It's not going to be the Jets with their young quarterback, and the Bills are starting a rookie also. So as long as Brady is upright, they'll do it again.
Well, I mean, I want to bet against because I just think they've been very, very fortunate. I've been my experience with these guys is they don't go gracefully into that long good night. I forget who wrote that. Was it long?
I'll ask our buddy Steve Fezzik. I'm sure he can find you a market for that. They can find you a market for everything.
But I mean, he's 41. You watch him; the balls are floating. The ball, he can't get the ball to the sideline anymore. He's lost a lot of velocity. I thought, he kind of got bailed out by the refs against Jacksonville. They're down by 12 against Philadelphia. Jacksonville had them down by 10. You look at it, they're down by 12. Were they down 25 against Atlanta? I mean, they had to make some stirring comebacks hey, look, tribute to him. Maybe one of the best of all time. Maybe the best coach of all time. No question. I think people get freaked out by the hoodie. But this team, well, I mean, it just seemed like they freeze, right? I mean, Pittsburgh seemed to have them beat. Atlanta had them beat. And they kind of went away from everything.
Well, it's funny. I forgot about that Jacksonville one. But, yeah, Jacksonville fully had them. And somehow they pulled one out of the hat.
There was a huge play in that game at about the 13-and-a-half-minute mark when Jacksonville's up 20-10. I remember they ran that throwback screen to was it James? It was James White, I think, up the left-hand side. He picks up about 15 or 20, and Miles Jack comes screaming across and strips him, and he causes a fumble, recovers it, and takes off, and they blow the play dead. And they look at the replay, and he didn't make the recovery till their bodies were not touching.
Right.
So the refs, by the rule, they're supposed to let that play continue.
Yeah.
They're supposed to let that play continue. Instead, they blew it dead. Now, Brady had the angle on him, but I'm going to go out on a limb here and say he probably wouldn't have gotten him down. But and that could have been ball game right there. So I'm just saying, they made a lot of – look, and the game against Seattle, they're down – were they down 9 in that game in the fourth? I'm sorry. They're down 10 in that game in the fourth quarter of Seattle a couple of years ago. Look. He makes a lot of plays, but eventually you're 41. Peyton Manning, 2013 was his greatest season of all time, right? By 2015, I think Brock Osweiler was probably the better quarterback, right? So, I mean, these guys fall off cliffs.
Absolutely. All right, we got our run.
Washington over 7.
Oh, yeah, so there you go. On top of some options, he's going Washington over 7. All right. Hey, Tom, thanks a lot. A lot of really good information. Thanks for joining us. We'll talk to you next week, hopefully.
Thanks for having me, Mike. Have a great night, everybody.
Bye.